If you've sought across from an insurance agent, you've heard the pitch. Whole life insurance builds wealth, while buying term life is throwing money away. But before you sign a contract that costs hundreds of dollars a month, we need to look at the math. We have to ask if this is actually a sound investment for your family, or just an engine to fund the agent's lifestyle. To answer that, let's strip away the sales tactics and look at what life insurance is actually built to do. It has exactly one job: replacing your income if you die. If you have a spouse, a dependent child, or a partner who relies on your paycheck to cover shared expenses, your sudden absence creates an immediate financial crisis. A lump sum payout steps in to pay the mortgage and keep the lights on. This makes life insurance a highly targeted safety net, not a default financial product everyone must buy. If no one relies on your income right now, buying a policy is simply a waste of your capital. If you do have dependents, the biggest mistake you can make is waiting to get covered. Look at this timeline. A healthy 30-year-old locks in a policy for $25 a month, but rates tie to age. By 40, the cost doubles. By 50, it jumps over $100. A sudden health condition can make you uninsurable at any price. Trying to save a few dollars a month in your 20s or 30s leaves your dependents exposed to total financial devastation later. Once you decide to buy, you have to choose between the two main types of coverage. Let's look at term life first. This is a temporary contract where you buy protection for a specific, predetermined window, usually 10, 20, or 30 years. For a healthy 30-year-old, a 20-year term policy costs that baseline $25 a month. In exchange, your family gets a massive $500,000 shield precisely when they are most vulnerable to heavy burdens, like a new mortgage and childcare costs. Agents often point out that if you outlive the 20-year term, the policy ends and you get no cash back. They frame this as a loss, but outliving your insurance means you are alive. The goal was never to collect the payout. The goal was to not need it. Term insurance is highly efficient. It transfers a catastrophic financial risk away from your family for mere pennies on the dollar. Then there is whole life insurance. This is a permanent policy that covers you for your entire life, and it includes a built-in cash value savings component that you can borrow against. That sounds great until you look at the price tags. Securing that same $500,000 death benefit through a whole life policy will cost that exact same 30-year-old roughly $300 to $500 a month. That is 10 to 20 times more expensive than term. The sales pitch justifies this massive monthly hike by explaining that the extra premium goes directly toward building that internal cash value. But the math reveals a different reality. This cash value account is highly restrictive and grows incredibly slowly, typically yielding just 1 to 3% per year.
Worse, these policies are packed with hidden administrative fees that continuously erode the extra money you are paying into the system. When you bundle your life insurance with a low-yield savings account, you end up with a mathematically inferior product that severely underperforms almost any standard investment. If whole life is so inefficient for the buyer, you have to ask why it is the default recommendation from almost every agent in the industry. The answer is found in the hidden commission structure. Agents are paid based on the size of the premiums they sell. Look at the payouts side by side. The commission on a small term policy is minimal, but the commission on a whole life policy is massive. An agent can routinely pocket 50 to 100% of your entire first-year premium as their upfront commission. This means the expert advice you receive is structurally compromised. The math heavily favors the salesman's vacation fund, not your family's protection. For the average earner, the optimal strategy is simple. Decouple your insurance from your investing. Buy term life and invest the difference yourself. Let's look at this chart tracking the two paths. If term costs $25 and whole life costs $350, you save $325 a month. Put that difference into an S&P 500 index fund at 7% for 20 years, ending with $202,000. Compare that to whole life cash value. After 20 years of sluggish growth and fees, you have just $40,000 to $80,000. There is a catch to this strategy. It requires the actual discipline to invest that $325 every single month, rather than letting it vanish into lifestyle inflation. If you stick to it, your family retains the exact same $500,000 protection umbrella during the critical decades when they need it most. Buying term and investing the difference is the mathematically superior playbook.
It secures maximum risk protection while building real, accessible wealth. To be fair, there is an exception. For very high net worth individuals who have zero debt, have maxed out every tax-advantaged account, and have estate tax concerns, whole life can function properly as a final tax shelter. But if you have a mortgage, high interest debt, or haven't maxed your retirement accounts, whole life is not your next step. For the vast majority of normal earners, term life is the strictly superior choice. To figure out how much term coverage you actually need, start with a simple formula. Take your annual income and multiply that by 10 to 12. So a $60,000 salary means you should target roughly $600,000 in coverage to replace your income and pay off major debts. Run that multiplier for your own household, including your partner's income, and lock in a policy while you are young and healthy. Understanding the underlying math strips away the industry jargon. It empowers you to protect your family effectively without enriching a salesman in the process. Just remember, Cash Control 360 provides educational content, not financial advice, so consult a fee-only fiduciary for your personal needs.